offers an appealing investment option because of the potential for lucrative returns and the various tax incentives that are available. Many people are unaware that the Tax Act of 1992 was created with financial incentives to boost domestic oil and gas. The ultra-rich enjoy taking advantage of these opportunities because the Act includes provisions that allow accredited investors the opportunity to offset up to 100% of their investment capital. There is no other investment category that receives the same range of tax breaks that are available to the oil and gas industry. Investors have several options to consider when investing in oil and gas. Tangible drilling costs are the actual costs associated with the drilling equipment for a project. These expenses are 100% deductible and must be written off over a 7-year depreciation span. With the exception of the drilling equipment, all items needed to drill a well are considered intangible. This includes labor, mud, grease, chemicals, and any other eligible item. These expenses usually make up between 65 and 80% of the total cost to drill a well and are 100% deductible. The deductible amount is contingent on the well being operational by March 31st of the following year. Whether or not the well actually produces or strikes oil does not affect the possible credit. A working interest is not considered to be a passive activity. Therefore, all net losses are active income and can be used to offset wages or capital gains. Smaller producer tax exemptions are exclusively for small companies and investors. This exemption allows investors the opportunity to offset 15% of all gross income from an oil and gas investment. Investors are not allowed to own more than 1,000 barrels of oil per day or 6 million cubic feet of gas per day. There are 4 main categories available to individuals who are interested in investing in oil and gas. Each of the following categories have different risk levels, as well as individual rules for eligible tax incentives. Oil and gas mutual funds are an excellent way to invest in the sector. This investment allows individuals the opportunity to diversify their portfolios with a venture that has limited risk. Mutual funds do not offer any tax advantages. There are several types of partnerships available for oil and gas investors, with the most common being a limited partnership. These partnerships are sold as securities and limit the investor's liability to the amount invested in the project. Royalties are returns paid to individuals who own the land where oil and gas wells are drilled. Landowners can earn between 12 and 20% of the gross production revenue. However, landowners are not eligible for tax incentives. Working interest is considered to be extremely high risk, as investors are liable for a particular amount of the ongoing costs associated with drilling, exploration, and production. The majority of investors who select working interest are extremely affluent and have an income that exceeds the taxable wage base for Social Security. While there are numerous benefits to investing in the oil and gas industry, it's important to remember that the discussed ventures are extremely risky. Per the FCC, only accredited investors who have the financial means to withstand a devastating financial loss are eligible for these types of investments. Syndicate Leads is a lead generation firm that produces fresh leads daily. We offer accurate, relevant,